Okay, so we're now at the question on page 13. This is regarding lecture 1. Confused about the lecture example of how to arbitrage by dual listing. The problem is that I don't know exactly when this question was posted, and we have talked about this topic both in the supplementary tutorials, and also if you were to go back to question 5 and 6 earlier. So question 5 also was about that even the page is similar to where you're referring to, jumping to queue. I already tried to explain what that was all about, and also for question 6, which is an extension of trading between Eurex and Singapore Exchange. So this further example actually is between the DAX and the Euro stocks, but the ideas actually are the same. If you were to look at the lecture, so this is page 77. So I already see my writings are still here. I already provided considerable details. I might come back to it at a later point when there are further questions where I can add something to it. Okay, thank you for that. And likewise, I think for the next question, so question on page 14, 12, 13. Confused about the examples about spreading two correlated instruments and futures. I mean, you have to be more specific about what you don't understand, otherwise it would take me 3 hours to explain the whole thing again. Now for this one also, I provided quite a lot of coverage earlier in question 6. So this is again trading the DAX versus the Euro stocks. So the idea is that they should be, or you think they are, connected by some kind of ratio, and let's just assume that is true. Okay, so the two should be moving sort of hand in hand, and the moment they start to deviate from each other, okay, then you try to do something about that by selling this one, or maybe buying that one, or doing a bit of both. And there is a methodology that you can do this. Okay, maybe I will talk about pairs trading a little later on. I think there is a question further down the line, but like I said, I did actually cover aspects of this part of the course. You can refer back to question 6. I think that should be helpful for you. Okay. Okay, now let me take a look at question 15. Okay, I'm actually quite glad that some of these questions are kind of repeating themselves, because that means that different students are actually confused or having problems with similar stuff. Now this one actually is a little bit similar to a question that was asked earlier. In assignment 2, we're asked to calculate the theoretical price of call and put, and they are the same when they're both at the money. However, why is the 105 call, which is 5% out of the money, more expensive than 95 put? You realize that. Okay, now this is a question similar to question 12 that I answered in the previous session. So if you want to know, you might want to just refer to that. They're not exactly symmetric. They are, however, identical when they're both at the money, as you pointed out. So let's say the price is 100 and strike is 100. And you can see that the call price is $2.85, $2.86, and so is the put option, when the underlying spot price and the exercise price are the same. Once you start to get out of the money, like 5% out of the money for call, 5% out of the money for puts, they are no longer, they are approximately symmetric, but not exactly. And in the in answering question 12, where somebody asked the question in a simpler way, I already explained why they are not exactly the same. Okay, you just have to look at the option pricing formula and what's embedded in the ND1 formulation. There is a there's a term which is the log of S, your spot price, over K, and the log of so this is part of the option pricing formula. So the log of 100 spot over 95K and the log of 100 over 105K, they are not the same. Okay, that's why. And then there are other things at play as well, not just these, but you know, for starters, this will actually impact your result, but that's not the only thing. Okay, good question, that. Thank you. So that is question 15. Now question 16, what is so-called pin risk? Pin risk is this: if you have let's say a call option, can be any option, doesn't have to be a call, and then prior to maturity the payoff function is like this. Now here the way the delta is changing is quite smooth, so here delta would be approximately 0 and here delta would be approximately 1, and it goes up slowly and gradually. Okay, and then around here delta changes faster than when you go out to the extreme, out of the money. Here delta is low and it doesn't change a lot as the price is moving by the same amount. Likewise here delta is equal to 1, it does not change a lot when the spot price is moving up and down. Okay, it's actually around here that delta moves around a lot, which is why I keep saying around this area, when it's at the money or near the money, delta moves a lot and gamma is high. That's why you have a curve like this. Okay, for gamma. Now, not only this, you think of it one level deeper. Okay, when an option is near expiry, I'm going to draw that here, yellow line. Okay, then I hope you can see this. Okay, the yellow line. If you are near the money and the option is close to expiry, then what happens is that the delta here around here, it doesn't change a lot, but round about this point, when it goes from being out of the money to being in the money, it changes very, very fast, which is why for that's why you get that graph, okay, of so this might be the delta of the gamma of a longer term option, okay, but for a shorter term it sort of goes like this. Either it doesn't change much, but when it's near the money, wow, all of a sudden. And when you have only, let's say, 1 day to expiry or 1 hour, okay, this yellow line here would practically be hugging, you know, the straight lines. So imagine if your strike was 100 and you only have 1 hour to expiry, and the spot price was sort of jumping around between 99.95 to let's say 105 cents. Okay, now by definition, technically, one moment is out of the money, and then the next moment is in the money, out of the money, in the money. And here, when you are so close to expiry, let's say you only have 5 minutes to expiry. How about that? Really, really close. So here, technically, delta would be 0, whereas here, delta would be 1. Okay, so you have practically infinite gamma, just sort of flip-flop between 0 and 1. And that is what's known as a pin risk, because you don't, when pin risk is this, pin risk is when you are very, very close to expiry and the spot price is kind of hanging around your strike and hovering and flip-flopping in or out either side of the strike, and then your delta is kind of switching from no delta to full delta to no delta to full delta. So you don't really know how to hedge it. Quite often you just have to take a view. You can't hedge, okay, under that kind of circumstance. So you just have to take a view on where you think it's likely to end up. If you're a trader and you have that kind of situation, it's quite unlucky. It has happened. I have seen it before. And sometimes they try to see if they can influence the price in a certain direction. Okay, that's pin risk. Okay, then let me have a look at the next one, which will be question 7 on page 17. How to calculate the P&L delta hedge of lecture 3, page number 43. So lecture 3 and page 43. How do you get these numbers here? Okay. Now we are talking about a stock which started at a share price of 50. Now at that point in time, the delta is 50. Okay, so if you long a call and short a put, is this long a call? Or it doesn't matter. Or maybe you short a call, you sold a call, and then you long some shares. So your delta hedge would be 50 delta. Okay, so if you sold 100 calls, you need to buy 50 shares, and when the price moves by $1, of course your hedge will go up by $50 because you are long 50 shares, and every share has gone up $1. Okay, now at this point the delta is now 46, is not 50. The reason it's 46 is that notice that here the gamma is 4, okay, and this doesn't, this looks like this is a put option, sorry. Okay, so you are you long a put, and you are short delta, and then you are long some stocks. Okay, long a put, so you are short delta. So here, so the delta becomes 46 because the new delta is the old delta together with the gamma adjustment. So that 50 minus 4 is 46. Okay. And delta goes down, or at least the absolute value of delta goes down because your put option becomes more out of the money. And then if it goes from 51 to 52, then of course your new delta P&L would be driven by your delta at the spot price of S equal to 51. Okay, so that's the reason for that. So that is I think question 17 here. Okay, let's take a look at some of the questions on page 18. Now, some pretty good questions being raised here again. So this is concerning lecture number 5, pages from 45 to 56. And so for page 45, the question is why we should buy the 90-day option and sell the 90-day option C and sell the 60-day option B because the vol is negative. Okay, let's go over there and have a look. So this is page 45. 45. This is again, so you have you can calculate as I have said before, if you know the volatility between 0 to 30 days and then 0 to 60 days or even 0 to 90 days, then it is possible to work out what is the break even of the forward vol from 60 day to 90 days. This is kind of similar to interest rates. Now here you have a situation where when you do such a calculation, and there's a formula given as well which I provided in my tutorials, and it's also in the lecture notes. It just so happens that when you do this forward calculation, the volatility, the 30-day volatility starting from 60 days to 90 days is negative. Now this very rarely, I doubt you'll see that happening in real life, but if that was the case, okay, now when you buy options, what actually drives the price apart from the spot and the strike in interest rate and dividend and all that stuff? The key parameter of course is volatility. Okay, so the higher the volatility, the higher the premium. Okay, and if volatility was 0, then your option is basically free. Now we have a situation where the forward volatility of this period, not only is it very low, not only is it cheap, it's actually negative. Okay, so if it was possible, then you want to try to put on a position which will allow you to trade this segment. Okay, now how do you do that? Well, if you go long this one, okay, the 60-day, and you go short this one, then basically you are going long this segment here. Okay, and then if you are long the 90-day and you are short the 60-day, then basically you are long this segment here. Okay, so finance sometimes is very neat and simple. Okay, you buy this one, you sell this one, then you are basically buying this one here. Okay, that is why we trade it like that, because the vol is very, very cheap. In fact, it's an anomaly because it's negative. Okay, page 48 to 50. How can the Greeks indicate whether we want the shares to remain stable? Okay, now it's very simple. if in doubt, okay, when you are long gamma and you are long theta, okay, you want lots of movements. In other words, when you are long options, basically, okay. So conversely, when you are short gamma and when you are, oh, I shouldn't say long theta, I should say when you are paying theta, okay. But when you are receiving theta, receiving theta, okay, you want stability. Think of it like this. Please forgive me for making this following example because it's not altogether so appropriate. But let's say you want to buy catastrophe insurance, okay, for hurricanes and earthquakes and whatever. So you pay money to an insurance company, and if there is an earthquake or tsunami or whatever, okay, you get a payout. Now, forgive me for saying this, but if there is a catastrophe, you are going to profit from it, okay. So you want the catastrophe to happen, okay, and then because you have paid, okay. Now, from the point of view of the insurance company who has taken your premium and will pay you, of course they are receiving payments, okay, so they want as little action as possible, whereas for you really want total complete chaos is what works best for you, okay. So that is why when you are long gamma, definitely you want lots of action, okay. And when you are long vega too, I forgot to mention that, okay. And when you are paying theta, so long vega as well, okay. And then on the other side, the guy has the exact opposite view, okay. What's next? So page 55, 56, cannot understand the logic below. If I drop from 100 downwards, I raise volatility, I'll get long delta from being short the 95 put and being long the 105 call. Okay, what's page 55? Let's have a look. Page 55. I think this is, if I may just go back a page, this is regarding if you are long a call at 105 and you are short a put at 95, and the spot price right now is around 100. So both the call and the put are out of the money a little bit. Okay, now first of all, if you are long a call at 100 and you are short a put, long a call at 105, and you are short a put at 95, and the spot is currently 100, you are basically trading a risk reversal here, okay. Now, one thing that I have explained to you and drawn to your attention is that for out of the money options, okay, if you, and in fact this was one of the questions being asked in the question set, okay. So let's take call options, okay. So when the for call options that are out of the money, the delta actually increases when volatility increases, okay. Now for out of the money put option, okay, the delta also goes up when volatility goes out of the money, okay. For in the money is the exact opposite. Now for put options, it's actually the absolute value. Okay, now let me show you what I mean by that. Okay, I like putting some numbers to it sometimes. So let's say when the spot price is 100, so at the beginning, so you are long a call, strike 105. Okay, so your delta would be roughly let's just say so the delta of your call may well be 46, let's just say. Okay, so it's below 50, that's less than 50 delta, and then you are short the put at 95. Okay, now a 95 put may have a delta of let's just say minus 46. Okay, so if you are long a put, you are short delta, but you are short the put, so the delta here also will be a plus sign. Okay, so you are net long and long, and you can see that because you are trading in this direction. Okay, of course you want the market to go up all the way to the sky. Okay, so of course you are unconditionally long delta everywhere. Okay, the fact that it takes a turn here and it takes a turn here, that's just a detail, but your general direction is heading towards northeast. Okay, up this way, so you're long delta. So here, if you were to put on a hedge, your hedge would be you would need to short 92. Okay, because you are long 92 there. Now what if the share price now goes to let's just say 97. Okay, 97. First of all, now without considering what happens to your the volatility, okay, let's just make an adjustment keeping volatility the same. Okay, so you started with a structure that is approximately symmetric, 105, 95, with the spot price in between. Now you are slowly migrating towards the lower end, and let's say the spot is now 97. Okay, now first of all, your call delta will go down to, let's just say 44. It doesn't matter. Okay, I'm just making up these numbers so it's easier to talk. Your put delta will go up. Okay, or if you long the put, let's say it now becomes minus 48, but because you are short the put, so it's plus 48. Okay, now your hedge hasn't changed, it's still minus 42. Okay, so it looks like, oh, okay, well my hedge is still valid. Okay, because when you add 44 and 48, one delta has gone up, the other delta has gone down. Now what happens if you now make an adjustment to the sigma? So you raise volatility and then you reprice. Now as you do that, generally the delta will go up. So the call delta may now be, let's say 45. Okay, and then the put delta may go to let's say 49. Okay, and your hedge is still the same, and as a result you find yourself, okay, if number one, this was your hedge and you started doing okay, and then number two, prices started to drop, and then if you purely just look at the delta adjustments, it still looks okay, but then when volatility changes, you're going to find that you are net long delta, because this one plus this one is 94. Okay, so you're long delta, and I would actually encourage you to experiment yourself play around with pricing these options when you make an adjustment to the sigma. Okay, now so here the idea is as follows. So I trade a risk reversal, and let's just say I try to delta hedge it. Okay, now as the market goes down, I thought I was still reasonably delta neutral, but the moment I raise volatility, I find that I'm long delta. Okay, now there are two things to say here. The first thing is, when markets are dropping, generally, when people are nervous and market conditions are not good, that's when option volatilities tend to go up. Okay, so you find yourself, if you have a structure like this, you find that you can't really help it. You have to raise volatility because the general volatility of the market is on the rise when prices are falling. Okay, number one. Okay, number two, when you do that, you find that when you thought you had a delta neutral position overall, you are actually long delta. Okay, so you are long delta when markets are falling. Okay, now that is not really a very good position to be in. Okay, long delta means you are happy when market goes up, but you don't really want to be long delta when the market is falling and maybe it has some more to drop. So you find yourself very, very busy trying to hedge your long delta position. And imagine if this was time and this was the market. Okay, so it's doing this and suddenly it does that, boom, like that, and then you are already busy enough trying to look at your book. And what's more, when you are here, your option position is working against you. You may not even have time to put on a hedge. Okay, that's the whole point. So here you don't have time to put on the hedge, and then it already does this. Okay, and it falls further. So that's what we mean in the question when you raise volatility and you end up being long delta somewhat, and this is really not the position you want to be in. So you'd rather that it was the other way around. Okay. I think that answers all the questions that are raised here. Okay, so this is now up to question 18 on page 18. Thank you.